turns questions into answers. Another ratio we want to touch on, still based on the theme of profitability, is operating expenses on sales. And again, let's break it up. We've got operating expenses as given on sales. So it tells you how to answer it. So what is our ratio then? Our ratio then is, so let's keep it as black. I think that makes it easier. Operating expenses, and we'll highlight. Please watch the color highlighting. It is intentional. Operating expenses all over sales multiplied by 100% because it is a percentage, your answer. There's highlights so you can see. There's a reason I'm highlighting. Green, green, and red on red. You see? Operating expenses on. There's your on sales. So what does this mean? This basically means how much sales is needed to cover expenses, daily expenses. Okay, so if it is good, then it needs to be dropping or remain constant. Yes? So it means operating expenses can't be increasing all the time. So if this ratio is good, it needs to be decreasing from year 25 to 26. It needs to be, for example, 5% and then 4%, or it needs to remain 5% in each year, if that makes sense. Yes? Because we're saying operating expenses, we do not want operating expenses to constantly be increasing. What else could this ratio possibly mean? It also tells us if expenses are being effectively controlled. Efficiently or effectively, yes. Effectively controlled. So we know expenses are being controlled well if they don't make up a large part of our sales price. Well, total sales, yes. So it tells us if operating expenses are being effectively controlled, if this remains consistent from year to year, and if it decreases from year to year. If you found this helpful, again, please leave that